Good morning, everybody. Welcome back to the Schwab Coaching Channel. It's our final day of the first quarter in Trader Talk in today's market. And I'm your host, Kevin Horner. It's a rainy morning here in Denver, Colorado. Got a lot of that this weekend. Pleased to be joined by my friend and Schwab's regional investment strategist, Michael Bruskof. Good morning, Mike. How are you, buddy?
Hey, good morning, Kevin. Doing well. How are you doing today?
Pretty fantastic, regardless of what the red on the screen might suggest.
You know what, Kevin? You and I were just talking a few seconds ago. Hopefully, maybe we'll start to see a little bit of a green shoot maybe later today, but we can only be hopeful. We'll start off with that.
Yeah, but as we often say, we know hope isn't a strategy, but there's a lot of ways to go about participating in the market nonetheless. We're going to acknowledge what we are up against here in the market, though, of course, keeping an eye on some important levels with all of you as we look through a number of important charts and details today. So with that, let's kick things off. Say hi to Mike Fairborn in the chat. He'll monitor things for us today. Get to questions that Mike and I are unable to get to for all of you, but we'll keep an eye on the chat as well. You can follow Mike and me on X, Mike Fairborn CS and Kevin Horner CS. And if you like today's discussion and the content we offer, please be sure to hit that thumbs up button down below, which will help us as we get this out to you all in the archive a little later today. Now, let's get to some disclosures, and then we'll dive into the fun stuff with all of you, of course. Remember, our discussions here are only informational and educational. We do not make recommendations nor endorsements for any particular approach or strategy to trading the market. We do, however, talk technical analysis quite a bit here. When thinking about technical analysis, this is merely a piece of the overall puzzle, everybody. We think it can be helpful in discerning entry levels and exit strategies for sure. However, don't base decisions exclusively off technicals. We encourage you to make that one piece of that overall puzzle, combining fundamental data as well as technicals and anything else that might make sense. There's a lot of narrative discussion going on these days. So you have to take all of that into account when basing decisions. All right, and as far as our agenda, it's more of the same. So we'll start broadly. We'll look at the S&P 500. We'll look at the NASDAQ 100, the Russell 2000, semiconductors as well, before getting to some sector action, some stocks in the news across the board. Let's dive right on in, Mike. Let's start us off with that S&P 500. Boy, we have opened and even gone down right to basically, Mike, maybe an important level here right off the jump today. Looks like our last trade is pretty darn close to about our low for the day, about 55.05 or so. Pretty consistent with the low we found about 2 weeks back.
Yeah, well, Kevin, starting off with that, let's just jump right into it, right? I mean, if you look at the S&P 500, can I call it a precarious level? We really want to kind of hold that level, right?
Yeah.
So, if I'm going to be the optimistic guy today, maybe this is the lows of the day. But if I want to be the pessimistic guy, yeah, Kevin, I'm a little concerned about that exact level that you highlighted right there. That level, would continue to put us in that downward trend of making a new low. And I'll call that an intermediate trend since I'll say almost early February that we've been doing that. That's not a trend we want to be in. I know you and I have a bunch of things that we're going to talk about today, but in particular, the S&P 500 continuing to hit, I'll say, air parentheses, shorter term new lows isn't going to make the market happy with some of the backdrop of economic news that we have going on, tariff news that we have going on. Those two things in combination with a technical level breaking down probably aren't the best for the market right now.
Yeah, there's a combination of factors that makes things uncomfortable here, as you laid out, Mike. Let's talk about the level where we seem to be sitting on and remind ourselves of the importance of some of these round figures. 5,500 is the ledge right beneath us as we speak. Many traders talking about the potential for 5,400 down below, Mike, which was a previously tested level of import back here in the summer of last year. So is this possibly a spot where we need to thereafter, if we don't hold the intraday levels we've set today, that could become a level of potential support for us over the coming couple of days, perhaps?
Yeah, as I'm looking there, Kevin, that 5,400 level is, I was doing some work earlier, over the weekend. That's a big Fibonacci retracement from those lows from the lows in August that would put us almost back right where you've drawn that line, right around a 76% retracement from that particular move upward. So it does kind of make me a little precarious. You know, me and you could have drawn that line a little differently, but it's the same. We're in the same area, and I get what you're showing on that chart. That's what I'm saying. If we were to break today's level where you're at with that white line, it does seem more like a magnet that we're going to kind of pull down there, because there's really nothing in between there to support us from an S&P perspective on a technical chart.
Yeah, and Mike, if you're just thinking about it from the technical breakdown, if we're going to go with the assumption, and this is kind of silliest to assume this, that my lines are perfect, we know better than that. But if the levels we're looking at, you know, we drew that from the August bottom. Reminder, that was the carry breakdown, right? The carry trade, Japan carry trade breakdown low August 5th, and we've had a good rally since then. This 61.8% retracement level, Mike, for a lot of bullish traders is the last ditch line in the sand for them, meaning that a takeout of 5,500 actually, for those bulls who put stock in the opportunity of what Fibonacci says, suggests that if it breaks below 5,500, they're looking at back down to 5,100, the place from which we began that rally, a full round trip. And Mike, we have seen more than a few round trip moves of late. Tesla is one that comes to mind.
Yeah, Kevin, I think as much as me and you love talking technicals, I think a lot of this is economic, right? Really, we're seeing some things, right? So last week, we had, PCE come in slightly inflationary, right? It wasn't great. It wasn't horrible. 0.1 of a percentage point, a little hotter than we were expecting. We've got consumer confidence, dripping down, consistently going lower month after month. I think we've had, almost 10 straight months of lower consumer confidence. Though that little combination right there of slowing economics, slowing consumer confidence, uncertainty about tariffs, uncertainty about interest rates, and you put all those things together, and I used the word 2 times already, the market doesn't like uncertainty. The market likes clarity. Kevin, can you tell me if the market's going to go up or down tomorrow? That's what the market likes. When there's all this uncertainty, the market only goes and really tends to go in one direction. And unfortunately, the direction we're seeing right now is what happens when uncertainty comes into the market.
Yeah, and I think you're absolutely right, Mike. Uncertainty is the one thing the market does not like at all. In fact, the market would be fine with certain, even if it's bad news, it's certain and clear. At least the market knows how to address that, right? The traders of the market then say, well, this makes sense. We know what this means, and we can deploy money appropriately. The fact is, if there's a lot of that uncertainty and they don't know where to deploy, well, then it keeps them from actually putting that money to work, which means we're not putting that money into the market. It sits on the sidelines, and that doesn't help anybody out, unfortunately. So ultimately, there's a lot to figure out. Now, there's a great question in the queue. Fitness and Dance wanting to know, does the green line we've drawn in at 5,400 mean potential support? Sure, it could be support. A lot of traders would tell you, like we showed that that Fibonacci retracement off the August 5 lows. They might tell you that a slip through 5,500 is more important than maybe the 5,400 catching a bounce. And I'll state further, hey, if we make a new short-term low, right now we're at matching lows. We would call that a match, not new lows, okay? So that's okay. That just simply means we haven't made a lower low beyond the one we made 2-3 weeks ago, even though we've made lower highs. What we are looking to do is to get out of this recent trend of lower highs and lower lows. And the first place it can begin is with a matching low here. So potentially the lows we've established today, if maintained, maybe we have a little bit of an opportunity in the short term, but ultimately we won't really know that down until we get a few more days, hopefully a few more days in hindsight, Mike, because the ideal scenario is that the lows of the day hold us up at 5,500, and then we start to rally back and challenge maybe the 20-day moving average and give us a little bit of a bounce opportunity. And The trouble, Mike, with Friday was that the move was so aggressive, taking out multiple layers of recent action. There was just no holdup to Friday's action. It was one of those range days, Mike, where the market just starts weak and there is no bounce in the action. And that's what we don't want to see today. We don't want a continuation, the back-to-back heavy days of selling like that.
Yeah, Kev, I'll give you two things, and then I'll let you move off of the S&P 500. But one thing I would say is last Wednesday was probably more disturbing. Last Wednesday, we challenged the 200-day moving average, and we didn't even get close. So if you kind of move in there, going back 4 days from now, right? Last Wednesday, when we tried to get above the 200 and were rejected at those highs, actually we opened there, and then we just kind of went straight lower. That's more of a disturbing day because we tried to get back above the 200-day moving average. And if I follow a lot of the Horner rules, it's not really good when we kind of try to pierce above and we come back and then kind of use that as a rejection. So I do hope that your secondary support line is that 5,500 spot. Yeah, I kind of agree with you. I hope that we can hold that, because if we can't, and it looks like we're kind of breaking through as I'm talking to you right now, if we're breaking down below there, then that continues that trend of new short-term lows. And that's not what we're going to like, or the market's not going to like. Who cares what me and you like?
Yeah, that's entirely fair to suggest, Mike. Obviously, I think a lot of traders are going to like the very same thing. We want the market to go higher. That's fair to suggest. But we'll have to see. Now, obviously, this is getting a little more weak right off the open, but we're hopeful we get a bounce here. Let's look and see if the Nasdaq's looking. The NDX, not a great look here, Mike, because that's a gap through lows of the last month and moving further to the downside. Mike, this is starting to reflect far greater weakness than we'd hoped. And of course, given the breakdown move now, Mike, I think bears have some levels with which they can start to position themselves. Meaning if you start to trade anywhere remotely back into the level from which we have fallen, bears might then start to get uncomfortable, but they're in a potential momentum-based move to the downside here on the NASDAQ 100.
So, Kevin, excellent observation there. What I would say is when I was looking earlier, over the weekend, I saw a really high correlation between the Qs and the S&P 500, which they're not always as correlated as they are, but they've been very highly correlated lately. That chart that you're showing me is a breakdown now of that correlation. So you're seeing the NDX kind of gap down. That we were just showing that white line on the S&P 500, and now you're seeing us break it on the NDX/Qs. Hopefully, I'll say hopefully, we're not in the hope business, but maybe we hold there on the S&P 500. But there is a little bit of diversion right there between those two indexes, and it's literally happening as we're talking right now.
But Mike, does it surprise you at all? I'm guessing not, given the nature of the NASDAQ, right? It's heavy on tech, semiconductors, etc. We've been led by semis and tech for a long time to the upside. Is there any surprise in your camp that we're being led to the downside by the same groups?
No, because of the confusion of slowing economic growth, quote unquote. If we're going to have a slowing economic growth, these high fuel, high growth companies, you would, air parentheses, think that they might suffer a little bit more. So that kind of makes sense. And these were the stocks that have led us up. I mean, I'm not bashing them. These are the stocks that got us to where we are over the last 2.5, 3 years. And I'm probably shortchanging the amount of years that those stocks have been leading the way up, the Mag 7, lack of a better term. But yeah, this is what led us up, I'll say, maybe is unfortunately going to lead us down.
Yep. And that's just kind of the nature of the market. Further, one of those things that we often talk about, Mike, is which areas are holding up better as we go through these difficult pullbacks. Those are the areas that can be the leaders as we get those bounces. Now, you will get bounces out of tech eventually, and you'll see bear market rallies that exceed returns that you versus what your expectations might be. But again, we've talked about this quite a bit. Let's try not to allow short-term price action to shift our longer-term viewpoints, which can be very difficult live and in the moment. So try to keep that in mind, everybody. As we move off of the NASDAQ, we're going to see an equally disgusting chart, unfortunately. That's the Russell 2000, Mike. We had what appeared to be another bear flag breakdown here, kind of akin to what we saw in the SPX and the NASDAQ. So again, some consistency, Mike, but we have also fallen through a pretty good level of importance here on the Russell now, looking at that 2000 level, which had been good for us, right? At least dating back to May of last year, where it became support, and we're right back below it. So we are in danger of a much more significant retreat here in the Russell.
Kevin, I know not everybody always knows how long you and I have known each other or how many shows we've done together. Open that chart up going back almost like 3 or 4 years. And you see that we're breaking back into, breaking down into a range that we had been range bound for multiple years. And we had been kind of trying to moving around in the NASDAQ. And I remember, or NASDAQ, in the Russell 2000. And I remember when you and I were talking one day on a show like this, where we were so happy that the Russell was finally able to break out. It was finally able to break out, Kevin. We were so excited. Like, oh my God, Russell. And now we've given back that entire gain. Just look at your green line. We're back into that zone. And the way a trading range works, because that's what we were using for a while for the Russell 2000, is we might come back down to the bottom of that trading range. Now, I'm not saying that we're definitely going there, but you're down below the 200, you're down below the 50, your 50's crossing below negatively your 200, your purple line crossing negatively down below the blue, and now we're breaking what was a previous resistance level now acting as support.
Yep.
So, yeah, I'm a little, again, it could pull back up by the end of the day. But if this were, me and you were talking 4 o'clock East Coast time when the market closes, that's not a good close right there. That's not a good close.
It's not. And we're going to allow the market the full day to help us out. Maybe
full day, Kevin.
That candle could look like a huge hammer by the end of the day. We don't know. It is the final day of the quarter. I'm not sure how traders and these funds are going to position themselves, but I think a lot of this movement we've seen in the last 3, 4, 5 weeks has been front running the expectational moves we get on Wednesday, right? So these actual deliverance of detail. And so question, Mike, I know I've got the Russell up here, but I'm just going to throw this at you as we migrate off of the Russell into the semis. Mike, what happens to the market here if we have front run listening to all of the headlines and comments suggesting that what was going to happen on tariffs is going to be much greater than expected initially, right? What if things get softer all of a sudden come Wednesday? What if the language is softened? What if the numbers that the president has stated in terms of the tariff expectations are softer on our international community? Is that going to lead to a potential bounce?
Kevin, that's the word of volatility, right? I do think that. I do think that from lack of a better term, a fundamental perspective, the market's slightly oversold. Now, it's oversold on the expectations of unknown news that can be coming on April 2nd, right? So we don't know what that news is. We have an idea. Maybe we get surprised, just like you said, to the upside. Maybe tariffs aren't 20% across the board, 25% across the board. Maybe they're not. And maybe they're a little less, I'll say, restrictive, a little less restrictive than we're thinking right now. And that would probably lead to a nice little rally in the market if that were to happen.
Yeah. I think there's a lot of thought to that extent, Mike. Obviously, our return numbers aren't, in the levels maybe of aggressive sell-off across the board. We know the S&P is in that 10% ballpark, the NASDAQ a little further, and certainly the semis a little worse than that. But, yes, we tend to overdo our selling in the midst of uncertainty. If we're going to aptly get some certainty this week, perhaps that's going to help clarify things and let us know if maybe we've gone a little too far in the selling as we try to reprice expectations for upcoming GDP for the remainder of the 2025 year and growth into 26 and beyond, certainly for the remainder of the next 3 3/4 years here, essentially, as we work our way towards figuring out what the administration's plan really is. As once we get some clarity on that, it'll certainly help. Now, Mike, as it relates to the semiconductors, you can see we took out a pretty darn important level here. I'm going to have to make a shift to my color scheme, Mike. That green line, the last green line I have on here, I'm going to have to shift to red now because it was a spot that we may have held up at. We did on Friday, but boy, it does not look great now, does it?
No, and I think this is, an extremely, as you know, it's an extremely volatile sector, right? It's considered more of the leading indicator of where things are going. As over the last couple of years, as the SOX was leading us up, nobody was complaining. Now on the other side of it, hold on one second. I apologize, Kevin. Yeah, I would say right now, I would like us to, if we could, I don't think it's, not sure about it today, we got to get back above that now new red line that you just drew, right? Because if not, then you're now look on your chart to the left. Where would you see a spot that we could call it support? Now we're maybe sitting there right now, barely. Right? It was a steep climb up. When it's a steep climb up, unfortunately, as you've already probably discussed with your client, with this audience multiple times, it's now almost a steep climb down, right? So, all right, so now you're just drawing a line at 30. I'll call it 3,900, give or take, right around there.
Yeah, right around there.
I probably agree with you on that spot, right? Because you've got that resistance level of last April through July. I'll call it last July. My apologies, Kevin. Last July, right there. You had a little bit of a breakout spot in the mid-October. So yeah, that kind of looks like an area, but that's another 400 points right there, Kevin. Right? And that's it. So, on an index that's already had a very steep correction. Yeah. So now we're looking at potentially some more damaging, right? That's again, you and I have been around the market for a long time. It's not fun when we get into these spots. But I think sometimes when we talk about, parabolic moves up, and if you look at the left of that chart, that's kind of what you saw. From 2,500 to up to 6,250, straight vertically up, unfortunately sometimes leads to this. And that big, area of consolidation that you have from October, through, month and a half ago, that would have been an area to, work off that overbought condition. And then once we broke below 4,800, you've been kind of, I'll say, air parentheses, a little bit of a free fall in the SOX.
Inevitably, got to draw a little Fibonacci line on here because I'm looking at these levels and I can see a few things to keep in mind. One, could be the ultimate bottom, right? This was the 2022 bottom. And really, that's the bull market we are maintaining in the SOX here, Mike. And if I drew that line to the peak, you can see how we're kind of in some semblance of areas, right? And so you got 4,000 as an important one, maybe down to that 3,900, right? So about a 100-point range of potential support. And that's at the 50% retracement. And Mike, we talk all the time about that so-called golden ratio, right? You get these big moves, you can give back about half. Bulls look at the half give back and say that's a potential entrance into the market for us. That could be that zone in there between 39 and 4,000 on the SOX, which is, like I said, about a 50% retracement of the entire move. Now, some traders would say that's all well and good, Kev, but I'd rather draw that from when we tested support and broke higher, and that might be right from here as an example. And you can see the importance of the level we just fell through now for that, right? Because now we're in danger of that so-called full round trip move from the October of 23 lows, right, to the peak. And if we stay below the 61.8% retracement for the entirety of the week, as an example, Mike, a lot of bulls will start talking about the potential for that full round trip back to the 3,200 from which we began that rally. So tough to say, obviously. We don't know where we're headed from here, but we do know we're at a pretty important crux as it relates to the SOX here for any type of potential short-term bounce. So I thought that was kind of notable as well. All right, Mike, let's take a peek at the VIX. The VIX is up today. Friday I showed the VIX and talked about the 5-minute bars here. We were talking on Friday about the importance of hanging on and pushing back at about 19.5. And by the time my show ended on Friday, you could see the VIX had popped in the final 10 minutes on Friday of this show, popped to the upside, and that was when the selling just took hold, everybody. So this looks like an inverse correlation relative to the S&P 500, and that rally in the VIX continued. Now, we've had that spike as the whole market has maintained its ugliness here, Mike, but we could possibly be seeing a little bit of a mean reversion all of a sudden as we have pushed back into 24 or so. Is there anything specific you're monitoring on the VIX at all, Mike?
So, Kevin, one of my thoughts on the VIX, as I'm looking at your screen here, if the market feels like we're at, and I don't like to use this term, so I'm not using it lightly, Kevin, but if we feel like we're at kind of a panic level, and I'm not saying that we are, but if we feel like that we're kind of there right now, you would expect that maybe the VIX would actually be a little bit higher for all this pending news that we have out there. So actually, when I'm looking at the VIX and I'm looking at a red candle now, is the volatility less now than it was earlier this month with all this big news coming out on Wednesday? So while I would think that the fear factor would be a little bit higher and we'd be touching those highs from early March, we're in fact a little bit lower. So is the market internally looking at the VIX, is it accepting of the moves that we're having in the market right now? Is this kind of just par for the course? I don't believe so. My heart doesn't feel that way, but the VIX is telling me something different.
Yeah, one of the things that I find intriguing about the VIX telling us things, Mike, is that we're not getting any true capitulatory action from it, right? It's not leading to substantial moves to the downside where everybody is saying, get me the heck out of these things, right? Get me out. Now, I know for many of you, it might feel like that, but Mike, we've been around the block a couple of years. The truth is, these selling instances, this has been a lot more orderly than your standard aggressive, hey, we're making a sell-off that we just can't stomach. We haven't seen that type of price action yet.
No, but potentially, like it's like a volcano. You're starting to get some spikes, and then maybe Wednesday we get, icing on the cake. I hope not, right? I hope it's something that the market, I hope what happens on Wednesday is something that the market was expecting. It was already expecting whatever we hear, right? If it's something that we weren't expecting to the good side, meaning tariffs aren't as severe as possible, you're probably going to see the VIX pull back in and see a little bit of that rally. If it's worse than we were expecting, my probability would be that you would see the VIX push above that 30 spot, meaning the fear factor should be much higher. So I think you're at an inflection point right now for the VIX, but usually sometimes the VIX is a little bit of a leading indicator, right? It's the price that we're paying to buy protection out there on the market. And how come, the market's not buying as much protection as we would kind of hope right now?
Yeah, you know what? It leads me to think that instead of buying protection, they're simply reallocating funds, right? Instead of wanting to stick with the SPX longs and protecting profits, a lot of those profits have already eroded. So now the opportunity isn't to own SPX puts, but rather to reallocate appropriately based on expectations. The problem is expectations are anything but clear at this point, right? So this is where we're getting a lot of back and forth, a lot of data necessary to define where we are now headed. And we haven't gotten any of that yet. Now, Mike, we're about a week and a half out, 2 weeks out from earnings season kicking off again. So that's a probable area where we're going to get some data and start hearing from companies. And it's going to help us understand whether we have maybe made the proper repricing of our market or not, and whether we need to go lower necessarily. We got a lot to learn, though, over the coming couple of weeks here. At least that's the way I'm looking at it. I'm guessing you're looking at it a little similarly. Okay, Mike. Other areas of note for you? Was there anything specific maybe that's jumping off as it relates to sector action? I noticed today we've got energy up a bit. We've got consumer staples up. I'll bet you're not at all shocked to see staples kind of leading the charge today, are you?
No, I'm not shocked at all. I'm not, holding up, right? We're above the 200-day moving average, right? So the staples, you would figure if if the world's, the market's having trouble, you would think that people kind of flock to these types of stocks that I need every day. I need tissues. I need toilet paper. I need toothpaste. That's where the consumer staples come in. And you would start to think that people would be flocking to those stocks. I have liked the same, and in that same sense, look at the utilities, Kevin. The utility stocks, they seem to be performing, pretty darn steady right now, which is again another area that people would still run to, because no matter what, Kevin, I still need to turn on my heat. I still need, hopefully air conditioning in a couple of months when the weather starts to warm up, but I still need my heat on, right? So I'm still using my utilities. It is a downward sloping line. You probably could draw a nice little, little triangle right there. But the way a triangle would work, if we were thinking about that, we would just proceed with the previous trend, which was upward after that brief pause. So maybe the base of that triangle would give us a breakout above that 420 if we were to draw a baseline of that triangle, probably right from where your 41.21 was. If you kind of went straight down that triangle from the high to the low, we'd probably get a nice little line that could break us out. So those aren't things that we should be seeing. If we're optimistic about the market, having the utility sector potentially look like it might break out, having consumer staples kind of up and green, and then we'll talk about the energy stocks in a second, but those are the three areas that are holding up. That's not probably the best for the market. That's just not the best for the market.
It just tells us something about the comfort of the market, right? When an investment dollar leaves growth stocks and leads itself into interest-bearing vehicles like utilities and REITs, real estate investment trust, like you get out of the REIT sector here, the real estate sector, or just straight up the staples, right? Because we know that's a group that, like you said, everybody needs staples. That's why it's called staples. It's a group that we need regardless of the health of the economy, comparatively to discretionary, for example, which looks a lot different all of a sudden, right? Discretionary investment is where suddenly, now granted, I'll say, Mike, the numbers are still there from the discretionary side, meaning retailers are still spending money. We in the country are still spending money. And in some cases, people are suggesting we're spending money at a pretty high clip. The concern isn't that we're spending still, it's where are we spending that money? And for a lot of Americans these days, Mike, that spending is coming in the form of debt, not actual savings or cash. So that's causing some consternation further. But you can see there's a very big difference between the look of the staples sector, Mike, and what's going on with discretionary here, which is in dire need of a bounce all of a sudden.
Yeah, we would hope. But your green line is more of the line in the sand that would be more disturbing, right? If we get, I'll say, negative news. What would be negative news this week? Tariffs across the board. Zero politics. It's air parentheses. It would look a little inflationary. And a little inflationary could cause the consumer to go back into, hey, I'm going to hide out in my, my little tunnel in my house, Kevin. I'm not going to spend any money. And that could set up potentially, if we were to break down below that green line, a really big head and shoulders pattern on the consumer staples. On consumer discretionary. So no, I don't want to see us break your green line. I would like to be a little more optimistic about that. And that is something right now, Kevin, to keep an eye on over the upcoming days. Do we hold that pattern right there on the consumer discretionary side? That's going to be a key spot right there.
Pretty key. I agree. The level there at around, we're going to call it 1535, 1540. Yeah, that's a pretty, let's see if we can hold that bounce. I mean, it's nice to see it as a hammer right now, way too early in the day, but we'll keep an eye on it. Now, then, of course, inevitably, we should look at some of these other areas. Let's talk briefly about energy, because we rallied into an area that we've been previously. Now we pulled back, but Mike, this is setting up for the short-term trader as a potential bull flag, which seems to be breaking bullishly as we speak. So, I was of the thought that perhaps we were witnessing a little less risk as it relates to what was happening in Russia and Ukraine, and I thought we might see this actually retreat a little bit. But since that thought I had, I was expecting further moves or maintaining the level in energy space, and we've rallied with energy. So specifically, are you watching oil here, or are you just watching the sector kind of collectively?
I think I'm watching the sector more collectively. I think the idea of energy itself kind of seems counterproductive, because if we could, oil's been coming down, right? What the price of oil has been coming down, which would be beneficial for our economy, right? That would be a disinflationary pressure if the price of oil were to come down. But as you see, and I think the energy stocks trying to get a little bit of a bounce here. I think, where you drew that line at 715 or so.
Yep.
I'd like to see a more definitive breakout, but I'll say, slightly impressed that they're holding up. They're above that 200. You can see the 20-day is trying to curve above. Your orange line is trying to curve above that blue line. That would be a positive signal there, as well as your purple line. If the purple line, which is your 50-day, were to cross fishhook above there, that would probably give a little credence to us probably breaking out of that spot right there, Kevin. So keep an eye on it. I like that it's holding up, I'll say, better than some of the other sectors in the market right now. So I'll give it a positive for that, because we always look for the green shoot. It's in a good spot right now. I don't want to say it's been breaking out by any stretch, but it's in a good spot. Better spot than the S&P 500 for sure.
Well, it certainly looks better than the SPX. And when you give today's today's action into account as well, it certainly looks like you're in the process of breaking a bull flag to the upside. Way too early to define it as such for a lot of traders, but it certainly looks that way, as we've already traded through the high of our low day, if Friday is our low day in this very brief pullback. The price movement in oil has been, let's pull that up here. We're going to look at a couple of these material details just real fast, everybody. So let's look at crude, which has been kind of hanging out under that 70 range. Now you got a little bit of a spike here into the 50-day moving average this morning, but ultimately the level around 67, pretty darn clear support. If I pull this back, you can see why, everybody. That has been pretty good support for us for a very long time. But it's the spikes to the upside and anything over 80 where things are going to get very uncomfortable from an inflationary standpoint, as you called out, Mike. Let's quickly hit up some of the more important areas that many of our traders are watching. So we're not going to talk about these from a true technical level of any kind, but I just wanted to highlight some of them. First is gold, which just continues to move. Noting here, we've just seen a series of higher highs and higher lows. Moving averages providing some support along the way, some continuation. Mike, the thought as it relates to gold is that there has been a tremendous push higher. Don't step in front of freight trains is commonly the thought process, right? Don't deny what you're seeing. But the movement in gold seems to be one of safety and fear as it relates to the broader indices. Is that how you kind of take what you've seen from gold here?
I would say I wouldn't disagree with any part of that. I think, over 100 years of market data, gold has been that safe haven, right? So you're seeing that right now. Will it continue to hold? I have no idea, but yeah, it's a very strong move for gold, I'll say, since the beginning of the year.
Okay. Yeah, it's been hard. I mean, wow, what an incredible move we've seen here. And for the record, that's not just in gold, because we've also noted something similar in silver, but maybe not to the level that we've seen it in gold, of course. And there's a little bit of difference, of course, in how the market reacts to these two, gold being the precious metal that it is, silver having more some commercial properties and benefits as well. So there's a little bit of a difference there. If we look briefly at copper, we can see that this is a little bit intriguing just from the narrative standpoint, Mike, because I was of the belief that in order for copper to move higher the way that it has, we'd have to have a strong economy, not just in the U.S., but internationally as well. And we've been told that that's not necessarily the case. So the movement in copper has been a little bit of a shock or a surprise to me, at least. Not to suggest that I know everything. That much I can share with you.
No, Kevin, I think number one, you're getting a nice cup with handle trying to form that base. If you took your white line and you kind of went to horizontally across, you're getting that cup basing pattern, right?
Okay.
So that you minus the little spike in October of last year. But that's a nice little move in copper. I agree with you that you would think that that's signaling an economic expansion. And I'm not sure that's where I agree with you. That's where maybe there's a little confusion, not maybe on your part, on my part, and our part. I'll say both of us. Why is this expanding when we're potentially moving into potentially, it could be a U.S. recession, maybe not. And it doesn't seem like these two things make sense. So I will agree with you. And sometimes when there's divergence from what you think, that something's going up when you think it shouldn't be, it does give you a spot to kind of highlight that and say, hey, maybe that's something that I'll just put in the back of my mind, that some things don't look as bad as we're hearing on the news all day long.
I think it's worth keeping an eye on. Yeah, building out your watch list, making sure you're watching all these charts. And then, of course, we got to talk briefly about Bitcoin, because this has been a real decent explanation of risk on versus risk off relative to the market. Now, I can't tell you which way the leadership is going, meaning is Bitcoin leading the risk on moves, or is it the market dictating the risk on scenarios? It's unclear at this point, but Bitcoin's up off of lows today after a pretty weak open here. But Mike, this is not reflecting the confidence in risk assets that it had been for so long. We had a perfectly appropriate consolidation over that 90,000 level, but for a lot of traders, just hanging out in these ledges over about the 200-day moving average, I think, keeps them in comfort zone for the most part. It's under the 200-day where things could shift a little bit, and I think just keeping an eye on Bitcoin from a standpoint of thinking about risk, right? Is the market comfy with risk? Is the market not comfy with risk? I think that's where it's pertinent for our viewers here today.
Kevin, couldn't agree more. Let's keep it above the 200-day, because we will have a different conversation if the market starts to continue to go down. This thing breaks down below 200, the 200-day moving average, and kind of moves more in correlation with the market rather than against the market. I think that'll be very interesting development over the next couple of weeks.
Yep, I'll agree with that. All right, Mike, we've only got a couple of minutes left. Let's take a look at at least one position here. I'm going to bring up KLAC, which is in the semiconductor space, and they were upgraded today by Morgan Stanley. And I brought that up because, there are a few individual groups or individual positions within semis that have been beaten down in advance of the selling, Mike. There's a few that come to mind. AMD is one of them as an example, but KLAC is not in a great looking pattern here, but they were upgraded to overweight from equal weight with a target at 870, up from 748. Now, Morgan Stanley expects KLA to outgrow the wafer fab equipment in 2025 and 2026 and sees a rich catalyst path for a re-rating of their shares. So, if you're a believer or you like upgrade opportunities, you might make note of the upgrade occurring at a gap level and the price action kind of telling you, hey, maybe that's a pretty important level here, Mike.
Yeah, I'm struggling to find a support level for this stock, but yeah, listen, Kevin, sometimes again, the difference between fundamental and technical, right, is that the fundamental person, the analysts, aren't going to sit there and wait for the stock chart to give them the signal for them to make something. They're going to go on PE ratios, projected sales, right, revenues to the company, and maybe the price point of which this stock is trading at isn't equivalent to the revenues that the company is generating, meaning it's undervalued right now. That's what that analyst is saying. So again, technically, it might not jump for me and you, but from a fundamental perspective, that's what you might be getting from that analyst.
Yeah, and of course, many traders love the idea of keeping an eye on these upgrade and downgrade opportunities and seeing how the market
100%.
reacts. Certainly, if this is a good support level, it can be started with a hammer candle like you've seen at least initially today. We'll see if that carries weight at the end of the day today. But the other one that I just thought I'd bring briefly was Wingstop, which also got an upgrade. This one from Jefferies today. Put up Wing here for you. You can see, Mike, the retail, it's a lot of these discretionary opportunities just don't look fantastic. Now, it's not bad to get an upgrade opportunity at the bottom of a trend, but let's not allow, one upgrade to necessarily change things. There's a lot of work to be done for Wingstop if there's going to be a new trend to the upside here.
Yeah, look, you had a nice double top up there at about 430. You had a double top there at 430. You broke down below it at about 360
or so.
Yeah, maybe a little even higher. So that's about what, 80 points, and 80 points from 350. You're down a little below. So again, you quote unquote, you should be a little bit higher, based upon that area right there, kind of wherever you're drawing that line. So again, fundamentally, maybe this stock is oversold. For technical clients that are looking at charts, look at that white line, Kevin. What client that's following technicals, that appreciates everything that you do, is really jumping in on a stock like that? Now, maybe you get a little bounce from 224 to 220 to 255. Maybe you could get that. But that white resistance line is going to be a tough line for it to break on that downtrend.
Yep, we agree. Even that points out the fact that a counter trend rally is always possible. If you're trading for counter trend, try to keep it short term. Try to be disciplined in your exit strategy. They can be good returns, but that doesn't mean you're breaking a downtrend that's been in place for a while here. So certainly something to watch. As always, Mike, love having you, man. I know we only get you once a month, but I really enjoy the conversation, and I know our viewers enjoy hearing from you. So thanks for being here, buddy.
Listen, Kevin, I always appreciate you having me on. You have a great day, and I wish our clients the best of trading today.
That's right. Let's all batten down the hatches. Be happy we are ending Q1. Thank you all for joining. Big thanks to Mike Fairborn. Follow us on X, Mike Fairborn CS and Kevin Horner CS. Hit that thumbs up below down for us there if you like the conversation today. But we appreciate you joining and participating. Don't forget Jeff's World with Schwab's international Schwab Center for Financial Research international specialist, Mr. Jeffrey Kleintop, on deck for you all. So thanks, everybody. Have a great Monday. We'll see you again real soon.